I'm going to talk about the new tax law and try to explain certain aspects of it. I mean, if anyone saw, well, I may be the only dork. I actually read lots and lots of stuff on the tax law before it actually passed. I was kind of interested in how Congress was going to go through the process of actually passing this law. And it's made up of literally hundreds and hundreds of pages of detail. And I'm going to try to synthesize the key elements of the changes that I think really affect your lives from a tax perspective. I'm an investment advisor. I'm not a tax professional. I know enough about taxes to be able to feel very comfortable talking about them with my clients, for example. But in the end, I will tell you, when something is a gray area, the best advisors in your life will make sure that you get in front of the experts from a tax perspective. Nobody should play CPA, in my opinion. But this law has a number of changes that I think directly affect individuals to some extent, and I'll tell you, there's a section of the tax law change that I'm not going to talk about at all. And hopefully this group, I've kind of geared this talk to a group that demographically I think fits what I'm seeing. But small business owners who own LLCs, S-corps, so pass-through entities, and many of you either own or have owned companies like that, the law has dramatic changes in place for small businesses. It's very complex. I'm a small business owner, so I've studied it, but I'm not going to talk about it at all. In the Q&A, which I will ask you to hold off on questions until after the main program is over. At that point, I'll do Q&A for as long as the Senior Center will allow me to answer questions. So, and there we can get into some specifics in your life, and it's okay. Just keep in mind that what you're saying hopefully is generic enough that it'll apply to somebody in the room. If it's so specific, I'll have to just make a judgment call and ask you we'll go off to the side and I can help you a little bit on how to think it through. But if it's something more general that will apply to other people, it's a wonderful thing to ask the question. And I'm going to talk about some changes. There are things that I will gloss over or omit. It doesn't mean I'm giving you a comprehensive review of everything that's changed, but some of the very key things. So this tax law, they say, is one of the biggest tax law changes since 1986. In 1986, there were some major changes in the Reagan administration. And this tax law change does have some pretty large implications. This picture here, and you may not be able to see it too closely, but I'm going to describe it for you. I honed in on single filers and joint filers. Single and joint, and each one of these charts shows taxable income on the sides under the 2017, which is the year that just passed, relative to the 2018 to 2025 period. So the new tax law. And I'll specifically focus on the 2025. Many of these changes we're going to talk about are automatically going to sunset and expire. Ironically, y'all can laugh and figure out my political persuasions, but ironically, the corporate tax cut, which was dramatic, is permanent. All of the individual tax cuts and changes are temporary. And they did that largely for legislative rulemaking reasons. They could not create a deficit spending bill after you look past a 10-year window of time. If you have deficit spending for as far as the eye can see, you have to actually pass the bill with a different split of votes. In other words, that was not going to be a filibuster-proof bill. So they used a very special legislative trick called the reconciliation process. And as long as they didn't violate the 10 years and out rule, then they could actually pass the bill without having over 60 votes in favor of it. And this is not new. It's new in modern history. Democrats have done it. Republicans have done it. It's unfortunate because I think it creates, of course, legislation that's one way. It's all Republican, all Democrat. And I don't think that's probably the way you should have tax law created. But That's all an aside. What I'm focusing on here are income brackets that are for single people, 160,000 and lower, and for married filing jointly, 300,000 and lower. So I'm kind of honing in on that with these circles. And what I can tell you is the final upshot of the change is that basically for comparable taxable income, the tax rate is about 3% lower pretty much across the board, 3 to 4%. So that's taxable income, and we're going to talk about that as we go along, because there's more to life than just taxable income. There's gross income, and then there are deductions. The net number is called your taxable income. It's what your actual tax is based on. So it's a pretty broad tax cut, percentage-wise, bracket by bracket by bracket. So to give you a focus on some numbers, what was once known as the 15% bracket, which is where a lot of people reside, it's now a 12% bracket. What once was the 25% bracket, you can now think of it as the 22% bracket. So just think of it as a 3% cut. If you go to higher income levels, it's similar as you go up, but I don't think there's any point in focusing on those who are making $400,000, $500,000, $600,000, $700,000. If so, I'm talking to like one or two of you on this group, or maybe even a half of you. One half of a person. Okay. Yeah, exactly. So that's the first change you need to understand, is that tax rates have kind of been shifted down by about 3% on taxable income. The second major change that affects your lives is the standard deduction. So we're going to get into some technicalities here, but how many of you are familiar with itemized deductions versus standard deduction? Okay, most of you are aware of it. Itemized deductions, you've got to keep track of everything and add it all up, and that's your deduction. The standard deduction is a way of saying, I don't want to keep track of any of the deductible expenses. I'll just take whatever the government's going to give me as my standard deduction. And if you look at this chart, between 2017 and 2018, it's essentially a doubling of the standard deduction. So every single filer type, married or single, basically saw a doubling. And for anybody who's over the age of 65, and I'm 99% certain that if any one of the couple, one of the spouses in that married filing jointly status is over 65, there's an additional boost of about $1,300 each. So another $2,600 on top of the $24,000 number now. Used to be $12,700, now it's $24,000. Remember, when you're over 65, there's even more. So it's $26,600. So that's a pretty big deal. I mean, all of a sudden the government's saying the standard deduction is a much larger number, meaning that your income is going to have this bigger subtraction.
Put a lot of CPAs out of work.
Yeah. Well, it definitely is a simplification, and we'll see some specifics as to how it's simplifying things. So that's number two, very big change there, standard deduction. Third, really large change is that this idea of a personal exemption. How many of you are aware of personal exemptions and what those mean? A fewer of you. Basically, for breathing, having a heartbeat, breathing, the government took some of your income off the top. They just said, oh, we're not going to count that. In fact, it's about $4,000 for every single living person. And in your family, that might be 2 people. It might be, in my case, a total of 5 people. These are significant numbers of $4,000 times that kind of a number. That concept of a personal exemption as essentially an off-the-top deduction, just for breathing, is absolutely gone from the concept of your federal tax return. So what the government gave you in the standard deduction, they effectively took away some, depending on your world, took away some on the personal exemption side. On the state side, for those, or I assume all of you file in Michigan, the state side, we actually have still the concept of a personal exemption. In fact, I think directly after the bill was passed, sometime in early January, there was lots of consternation and legislating going on in Lansing, because when the IRS eliminated, when the federal government eliminated personal exemptions, it has an implication on the actual tax forms on the state side. It actually says, go to your federal return, get your personal exemptions, and put the number here. Well, if you can't find it over here, how do you put it over here? So, and they didn't want to have, the state did not want to have an effective tax increase by eliminating personal exemptions by default, so they had to reinstitute the whole thing through some legislative magic. So don't think personal exemptions are gone forever. They're still there for Michigan, but they're gone for on the federal side, which is a big change. I mean, family of 3, that's $12,000 of additional taxable income. Family of 2, that's $8,000 of additional taxable income. Now, the standard deduction's higher, so that helps offset it. But it all comes down to the math of your life when it comes to taxes. Now, I'm going to talk about some changes to itemized deductions. So I talked about the standard deduction being higher. So to begin with, I put the symbol up here to kind of remind you that now you have a new hurdle to leap over. If you plan on itemizing and having it actually have an impact, you've got to compare it now to a much higher number, or else you're just going to go with the standard deduction. Bigger hurdle. These are the items that have been on tax returns for itemized deductions in the past, and I'm going to talk about what's not here and what's changed, because they changed how itemized deductions work. First off, charitable donations still exist on the tax return. We're talking about Schedule A of your tax return. Charitable donations still exist. No changes. Mortgage interest still exists, but there are changes that I'm not going to talk about. And I'll just give you hints. The way in which they counted interest that's deductible, you could have deductible interest if it was a home equity loan versus a first mortgage. But the way in which you use that home equity loan, if you used it to improve the home, then a large portion of that interest can be deductible. If you used it to buy a car or go on a vacation or fund a kid's college tuition, then it wasn't deductible. So I did go into it, I lied, but mortgage interest now, they have a whole different way of categorizing it. And effectively, it means less mortgage interest will be deductible for people. If you want to know more about that, I'd be happy to put on the frontstreetfoundation.org website a link to explain the change. Health expenses, so out-of-pocket health care costs, medical expenses, that's on Schedule A. Everything here we're talking about Schedule A. It still exists. It is subject to limitations still, and the limitation is this: 7.5% of your adjusted gross income creates a floor above which any medical expenses will become deductible, below which they're not. That's always existed. It was 10% for a while. It was 7.5% for a while. And I'll tell you, when they were going through all the tax negotiations, this was off the table, was going to be gone, if that's proper English. And it was brought back by specific senators who wanted to make sure it was in there for pretty obvious reasons. Who has medical expenses that will be deductible? And I'll tell you, examples of that are people who are older and they vote. Secondly, they vote in high numbers. Secondly, the people who classically take advantage of this will be people who have a couple where one of the spouses is going into a long-term care facility and there's lots of expenses late in life, and that is utilized in a pretty big way. So it was an easy one for them to throw back in, I think. Property taxes and state income taxes. I put them together and I put a check mark next to it because Congress created a brand new limitation on state income taxes and property taxes. This is also referred to as SALT taxes, which is state and local taxes, SALT. But it's property taxes and state income taxes. You can't deduct in combination between these two things more than $10,000 now. So if you have a home that's valuable, or you pay a lot of state income taxes and you're exceeding that $10,000, now know that you are getting sliced off at $10,000. If you plan to itemize, you have less to itemize now. Most people don't. So this is really impacting high property value owners, high property tax states. The politics behind this, of course, was it affects California, it affects New York. Those people vote Democrat. That was the game. I mean, that was the political game that was going on. This was slated to be gone. And so it was negotiated back up to $10,000 because, well, it also has political implications. So this is a pretty big change for some, not a big change for others. One of the bigger changes is that inside the miscellaneous expenses on Schedule A that are deductible expenses are things like investment management fees. So the fees that I charge out of accounts that are taxable accounts were once deductible, subject to another little calculation, but they were deductible in large part. Those are no longer deductible. So I will tell you, your advisor, if they're managing your IRA and they're managing a taxable account of yours in combination, and you are not going to be itemizing, meaning you will not be getting, well, first off, you're not going to get a deduction for the investment fee. Instead of taking that fee out of your taxable account like they used to and you got a deduction, they should be switching their fee to be taking it out of the IRA that they've been managing. So the IRA's fee should be coming out of the IRA as opposed to coming out of a taxable account where it was once deductible. So you should talk to your advisor to make sure that you are getting the benefit. And now let me tell you, you take it out of an IRA, that's money that you've never been taxed on, so therefore it is by default a tax-deductible fee. So you want to maintain the tax deductibility by having it come out of that IRA. So it's a mechanical thing you probably should just talk to your advisor about. And to a smaller extent, tax preparation fees are no longer deductible. Safety deposit box, no longer deductible. Moving expenses, I'm 99% sure that also was eliminated. Those are all things that fell under that miscellaneous expense deduction. And that one, just to get technical on you, they weren't all deductible. They were subject to 2% of your adjusted gross income. So there was always a little floor, above which deductible, below which not. So if you made lots and lots and lots of money, maybe you didn't have all of it deductible. But if you made reasonably smaller amounts of money and you have investments, then you probably were having deductible expenses. So, in summary, this is probably the biggest change, property taxes and state income taxes, and the elimination of all of your miscellaneous expenses. So think about what they've done. They've created a bigger hurdle in your deductions. Standard deduction is bigger. And they've made it so that basically you're not as easily leaping over the hurdle because now they've limited and eliminated some deductions. All of this basically means that, and I don't know the number specifically at the end of this, but during all the negotiations, that the vast majority, we're talking 30% used to itemize of tax filers, now it's closer to 10%, 5 to 10%. So they've captured a lot of people who were once itemizing, and they're saying, you no longer need to do that. Well, it's no longer beneficial to do it. I mean, you can do it all day long if you want to have fewer deductions. I mean, I don't think anyone's going to want you to do that, but I'm going to talk about a couple other changes that may or may not affect you, but it might just be of interest to you for education. Besides this idea of miscellaneous expenses being gone completely, the alternative minimum tax, if any of you were affected by it, it was basically in 1969, the government set up, it was designed to capture something like, I'm going to use a number, but I'm sort of lying, like 100 wealthy families. And they set up a tax law that said, my gosh, these people are not paying their fair share in taxes. I mean, they're literally able to skirt the tax rules. We need to set up an alternative tax calculation that at least says this is how much you have to pay percentage-wise. And it was designed to capture a very small number of people. I mean, it was a ridiculously small number of people. They created that law, and on purpose, there's no way it was a mistake, they did not adjust the calculation properly over the course of 30 and 40 years. So increasingly, as we got into the 2000s, they actually had the alternative minimum tax capturing more and more and more and more people. And ironically, what it captured was not those who were making $1 million, $2 million, $3 million. They were paying more than the alternative minimum tax anyway. It was actually capturing people who were making $250,000 to $500,000. You know, dual working professional couples, let's say, doctors, lawyers, whatever it was, that are not making extraordinary amounts. I mean, they're making lots, but they were getting really captured in there. Once you start making more money, the AMT never really affected you. That is effectively gone. And I say effectively because when you run the numbers with how they're doing it, that group of people who are getting captured in that are not going to get captured in it anymore. And the group of people who make more money were never going to get captured in it to begin with. Why they didn't just eliminate it completely is beyond me. But they effectively eliminated it. This icon here with the big gift is to represent estate tax exemptions. Before 2018, basically the rule was that estates, married couples or any individuals, and then married couples, you double everything. Married couples could have $11 to $11.5 million of net worth and not be subject to any estate taxes. Every individual had like $5.5 million that they could exempt upon their death, and that exemption passed over to their spouse, and then that spouse combined it with theirs, and they have $11 million. Congress doubled it to $22 million or so. So there are states that were between 11 million and 22 million who now are not facing that 40% estate tax. And we're talking about a ridiculously small number of people. But for those ridiculously small number of people, we're talking about millions of dollars worth of tax benefit from this tax law change. Lastly, probably the biggest thing that'll affect your kids, grandkids, some of you, I'm not aging you at this point, that there was a really large change in the way the child tax credit, the amount of the child tax credit. So this one to me is one of the more ridiculous changes, just to talk about politics, and then I'm going to talk specifics and give you some examples. The new tax credit for having a child that's 16 or under is $2,000. And in the old days, and I say old days like months ago, in 2017, you didn't get a child tax credit if you made as a couple. So let's just assume you're married, you're filing jointly, you have a child. You didn't get that tax credit, which was smaller. It was $1,400. Now it's $2,000. You didn't get it once you started making around $150,000. It phased out, and you no longer were getting the tax credit. So if you made really pretty good money, you weren't getting a tax credit. They took that limit, the phase out, and they started that phase out at $400,000 for joint couples. So now any couple that's making $399,000 and lower gets $2,000 literally credited against their tax bill, so it's much better than a deduction. A credit is like literally taking taxes off, $2,000 per kid, and then anybody who has a child that's a dependent or taking care of an elderly parent gets an additional $500 credit for anybody who's over the age of 16. So that could actually impact some of you. So that's a big deal. They also, more little minutia, they also made it so that if you don't pay taxes at all, so if you're a lower income family and you don't really pay federal income tax, and there's a large proportion of people filing that don't pay federal income tax, they do pay Social Security tax, they do pay state sales tax. So they pay taxes, they pay property taxes, but they might not pay federal tax. Even if they don't pay, the government has a refundable tax credit for having a child, and I think the number was $1,400 out of that $2,000. Might be off by $100 or so. But you actually get a check back for $1,400 per kid. So the design of this, Marco Rubio brought that increase into play. This literally came down to 1 or 2 senators at the end of the day could negotiate exactly what they wanted because they had complete and total control, because if any one of them left the group, the whole thing fails. So this was a high-intensity negotiation. Marco Rubio insisted on this, and it is a direct counterpoint to losing all those personal exemptions. So if you have a family of 3 kids and your standard deduction goes to $24,000, but you have a mortgage and you've got other expenses that added up to $24,000 in property taxes anyway, and then they took away a family of 5 people, all of a sudden they were going to be facing a very large tax increase. Even though rates are lower, they still were going to have a tax increase. This was the way of saying, okay, we see that that's going to happen, but you're going to get now this tax credit. And we're going to give it to people who make more money than we used to give it to, because they were going to be facing a pretty large tax increase. So this was a way of really countering that. And so in the end, I will tell you, all of this change was supposed to create simplification. I talk to accountants all the time, and I can tell you, when you layer in the complexity of small business deductions now with this pass-through thing, this is not simpler. It's not necessarily more complex, but it certainly isn't a lot simpler. For individuals, standard deduction relative to itemized deductions, that's pretty simple. So I totally give credit for simplicity on that front. So those are some major changes that I wanted to highlight. Okay, I'm going to go through an example of the old law and the new law, and I didn't want to give you too much minutia, so I used pictures, few in numbers as possible, and I'm going to compare the old law to the new law, and then I'm going to give you some tax tips or tricks, and I'm going to show you one specifically, and then we'll go to Q&A. So I'm going to walk through the icons here so you can see what it is I'm building. So this is the old law. This is a joint couple. I'm going to call them over 65 because I went and found a picture of a couple that kind of looks like they're over 65. They're walking and they're happy and there are no kids anywhere. So they have to be over 65. That's my attitude. Okay. And they have 4 sources of income that I've highlighted here. One is Social Security income, and I put a little icon here to say the taxable portion of it, because I want you to know that some of your Social Security may not be taxed. It could be as little as 0. It could be as high as 85% of it. And it all depends on all your other income sources and level. I did a program, I'll point to a couple of programs along the way, but I did a program on Social Security, and I talk about taxation of Social Security, and it's on that frontstreetfoundation.org website. So if you need a little more of a refresher, you can go and watch that. Then this couple has IRA distributions, so they're taking money out of their IRA up to $15,000. So I have $22,000 to start for Social Security, the taxable portion. $15,000 coming out of the IRA. They happen to own a rental property or 2 that generates $25,000 of taxable income. And they have a pension, $24,000. This couple, bottom line is that their gross income, before thinking about deductions, gross income is $86,000. Pretty simple setup. Everything inside this first circle are all the itemized deductions. And I'm not going to talk about specific dollar amounts because I don't really care. What I am going to tell you is it all adds up. We're talking about property taxes, state income taxes. There was no limitation back then, but that's what those 2 things are. The investment fees they were paying, deductible, tax preparation deductible, health expenses, mortgage interest, charitable donations, all the classic things added up to $23,000 of itemized deductions for this couple, this hypothetical couple. And the standard deduction back in the old days, 2017, was $15,200. Because this was an over 65-year-old couple, they got that little boost. But you can see that they're not going to use the standard deduction. They're going to use their itemized deductions because it exceeds it. So they have to do all the bookkeeping, all the keeping track of this, handing it to their CPA, waiting around for all the statements and everything, and sending it off to them. And it was a bit of a pain. And this is the way it was. They got $23,000 of deductions knocked off. And then they're living and breathing, so they get $8,100 knocked off. 2 people, $4,000 or so each personal exemptions. If you do the math on all of this, $86,000 of income minus the $31,000 of deductions and exemptions, you end up with federal tax of around $7,300. So this is the old law, and we'll come back to it because I want to show you a little bit of comparison. Here's the new law for this same exact couple. Taxable Social Security, the same. All the income sources the same, all the dollar amounts the same, $86,000 of income. Everything starts to change when you start talking about itemized deductions. You no longer have investment fees deductible. You no longer have tax prep fees deductible. This right here, I didn't put anything there, but that couple could have been affected by having too much in property taxes or state income taxes over the $10,000 limit. Charitable donations the same, mortgage interest generally the same, let's call it the same. Make sure they don't have a weird home equity loan that they used for a cruise around the world with their grandkids. And the bottom line is that because of the elimination of some things that I mentioned, I put on there that they had $17,500 of itemized deductions relative to the before $23,000. So they've lost some of their deductions. So this couple looks at it and says, well, my gosh, we're standard deduction filers. In fact, 2018 new law, it's $26,600, much bigger than what their itemized deductions are. So their world becomes very simple when they talk to their CPA for tax prep. They don't ever talk about where's your property tax statement, what about your donations, what'd you pay in investment fees. None of those questions come up. Mortgage interest, all the health care expenses, everything all itemized. Forget it. I'm a standard filer. $26,600. Life got simpler. They got an additional deduction. It's a benefit. But they lose $8,100 of personal exemptions. So they used to have deductions and exemptions of $31,000. This couple now has a standard deduction of $26,600. They are literally deducting less on the same income. Despite all of that, the one overriding factor when you calculate their tax is they actually got a tax cut of around $600, and it's because the overall tax rate is down about 3%, pretty much across the board. So despite all the machinations of what they're gaining and losing and what they're counting and not counting and the standard deduction going up and the personal exemptions going down, in the end, they get a tax cut of some modest proportion, much simpler tax code, $600 savings under this scenario. So that is an example of the kind of change that people are under. I gave you some hints about younger couples with multiple kids, how this is going to affect them. Certain people have large deductions that might be investment fees that are large. There might be a large property taxes, a second home. These things are now going to be affecting their taxes. But you can't really know the final result until you actually run the calculation to see. And I will say that the articles that I've read is that it's something in the range of about 80% of all tax filers are going to feel a tax cut. So this is a pretty broad-based tax cut. It means there are people out there that are going to pay more. I have a few examples in my client base where I know they'll pay more. And in most cases, the ones that are going to pay more, it's not catastrophic. It's reality, but it's not catastrophic. They can handle it. But it's a pretty broad-based tax cut. So now I'm going to get into some specifics and some specific tricks for you to think about. And something that I didn't bring up earlier that I always bring up with people. There is a very special tax rate that still exists under the new law versus the old law. So it didn't change. It's that if you have capital gains, if you have income, I should back up. If you have income that's inside that 12% bracket, used to be the 15% bracket, but now it's a 12% bracket. Couples making $80,000 or less, taxable income. when you look at all of your taxable income and the sources of that income, if a portion of that income came from having a capital gain, buying something and selling it at a gain, that capital gain is going to be taxed at 0% by the federal government, if it fits inside that 15% bracket, if it's part of your income inside the 15% bracket. It sits, think about your capital gains sitting on top of all your other sources of income. So if you have other sources of income that keep pushing everything up and you get all the way above the 15% bracket, well then your capital gains will be taxed at 15%. But if you have lesser income and that capital gain is sitting inside the 15% bracket, it gets taxed at 0. Bush put that into place many, many years ago, and it's seemingly quite loved. And so it's still in there. So the strategy there is that if you find yourself in a lower tax bracket, the 12% bracket, in an unusual way, it might be all the time, but if you have a lower income year and you happen to have things that you've got capital gains in, then it's smart to strategically take those capital gains when you're not going to have to pay any federal income tax. Be aware of the fact that you will pay state income tax, 4.25%. But that's a pretty low tax for something that you've had a long-term gain built up. So just keep that one in mind. Number 2 is the charitable donation out of your IRA. The technical word for this, or phrase for this, is a qualified charitable distribution, QCD, but people call it a charitable IRA rollover, I guess is the phrase that people use as well. But the idea is it's money that you can use out of your IRA to make a donation directly. And it has tax benefits for you to think through. And I'm going to show you a specific example of it and then wrap it up for questions and answers. So now I've created the most complex chart I've ever created. And depending on your reception, it may be the last time I ever create anything quite this complicated. But we've seen something like it before, so I'm building on complexity, which I think you guys can handle. Same couple as before. Taxable income from Social Security, all the other income sources, and general levels, $15,000 out of the IRA, just like before, rental income, pension income, Social Security of $22,000. Let me walk through an example where a person is over the age of 70 and a half. So this applies to everybody over the age of 70 and a half. Or I should say, it applies to none of you who are under 70 and a half. That's a better way of putting it. So if you're under 70 and a half, you can literally close your eyes. But you can prepare for when you are. The government requires you to take out money, a certain minimum amount, out of your IRA once you hit the age of 70 and a half. In fact, on the frontstreetfoundation.org website, there's a whole program on RMDs, required minimum distributions. If you want to learn about that, you can go and listen to that one. Okay? It's very popular. The talk I gave last week on withdrawal strategies in retirement, all of the questions were on required minimum distributions out of IRAs. So it was, I don't think there was any other questions other than that. So that program is pretty popular, and I'll probably be doing that again because I think people really need to hear about it. So this is an example now, though I'm trying to change a few things in this scenario. This couple has charitable intent. They only were taking $15,000 out of their IRA because that's all they felt that they needed. The government says, well, no, you need to take out $8,000 more. You need to take out $8,000 more to satisfy the required minimum distribution. We want our tax money, and the calculation is you need to take out $8,000 more. So this couple takes out the $8,000 more to satisfy the required distribution. So that's the only real first change. And of course, this couple says, well, I don't need the $8,000. I'd rather give it to charity because we have charitable intent. I don't need the money. My church needs the money, whatever. So they say, well, I'm just going to donate it. So that's great. I'm going to have $8,000 more of income, and I'm going to donate $8,000 more to a charity. So I'm going to be just fine. Government's not going to get any tax money at all. Let's follow it through if they actually take the money out, put it in their bank account from their brokerage firm, and then they take their checkbook and they write a check for $8,000 to the charity. Let's follow along with what happens. Under the new tax law, first off, they have $8,000 of more income. That shows up. They take the $8,000 and they increase the charitable donations by $8,000. They add up everything that they have as itemized deductions. Now they've got $8,000 more. It's no longer that $17,500 number under the new tax law. It's now $25,500. But they didn't leap over the hurdle of the standard deduction. It's $26,600. It had absolutely zero impact on their standard deduction. They still lose their personal exemptions because that's gone. Then things ricochet back to their income because now they have more income from various different sources, $8,000 more, and Social Security says, well, that's great, you've got more income. Now we're going to tax more of your Social Security. So instead of taxing only $22,000, let's say they tax $26,000. I'm telling you right now, I didn't do a calculation to see how that worked. I'm just showing you. Okay, $26,000. So the final end result is that they had $8,000 more of their distribution income, $4,000 more in Social Security getting taxed, a total of $12,000 of additional income, gross income, no additional deductions even though they donated the money, and they paid $2,500 more in taxes than they did before. So this is going to happen to people who think that when I take income in and I give a donation, isn't that supposed to be a net zero in my life? Isn't that supposed to not hurt me? The fact is you're going to pay taxes on more of your income because of that effect, of the increased standard deduction, if you don't leap it. There are examples where you're giving more and it starts to leap it. All of a sudden you have 27, 28, 29, 30,000. Yeah, a portion of it is helping you. But whatever you're sitting underneath the $26,600 is going to be wonderful donation to a charity, but you're not going to benefit tax-wise from it until you exceed your standard deduction. So this is when you don't do a qualified charitable distribution out of your IRA. But when you do, let me talk to you about what it does. Same exact chart, but this time you're using the qualified charitable distribution. You are going to be sending the $8,000 directly to the charity. You're not taking it into your bank account. You're talking to your advisor. You're telling the brokerage firm, I want you to send it to this 501c3. Here's the address, and here's the dollar amount that I want you to have sent it to. You can do this in, Gene, if I'm right, $50 increments, as low as $50 out of Schwab, for example. And I'm sure that all the brokerage firms are similar. It's administratively additional work, but it's not, I mean, we do it and it doesn't make us cry. It's in the end, it's good for the client. So $8,000 goes directly to the charity. Very critical, it must go directly to the charity. It cannot go into your bank account and then you write a check. It has to go directly. So it's a direct contribution to the charity out of your IRA. What does it do? $8,000 goes completely out. It has no impact on your taxes. Zero change because zero income comes in. Because it's not coming to you, it's going to the charity. Charitable donations, no change from before because you're not getting credit for a donation at all. Went to the charity, came out of your IRA. Government doesn't see income. Government doesn't see any additional deductions. Your same $17,500 of itemized deductions is compared to the same $26,600 standard deduction. So now you're still at $26,600, just like the person who made the mistake of sending it to their bank account and writing a check. The final taxes, $6,700, absolutely no change whatsoever. They were able to take that extra money the government wanted and give it to charity, and the government got zero taxes and the charity got all the money, and you didn't pay any additional taxes. So this is an example of, and it's going to happen more and more, because whoever's getting caught up in the standard deduction becoming the way of life, these little donations that you're making thinking that you're getting a tax deduction, the entire language of 50C3s to an extent is going to begin to change. Instead of the pitch that says, we'd like you to give money for this wonderful cause and it's tax deductible, and in some cases they might even flip it around, you want a tax deduction, make a donation to this charity. that language is not going to apply to the vast majority of people. If I just told you that 90% of the people are not itemizing, it means 90% of the people are getting no incremental benefit from a donation. They can get a benefit once you hit 70 and a half and you have to take money out of your IRA. You're allowed to do a qualified charitable distribution out of your IRA and satisfy your required distribution. So this is going to be an increasing tool that I think people should be thinking about. It's added complexity, for sure. It's work. But once you get the hang of what you're doing, it's smart. So with that, I'm going to wrap up the quick review of the tax law change, and I'm going to move to Q&A.